Hello, everyone. We'll try and get started right about 3 o'clock so we can stay on time. So we'll give it just 2 more minutes or 1 more minute for any attendees that are going to show up here. Okay, I think we can go ahead and get started. I just want to say thank you for everybody for taking time out of your afternoon to join us today for our market update. By way of introduction, I'm Brad Engle. I am the Director of Research, Trading, and Portfolio Analytics here at GHP Investment Advisors. Joining me today is Christian Lewton. He is our Chief Investment Analyst.
Hi, thanks for joining us today.
We'll go ahead and jump to our disclosure page, one of the more important pages. While we're doing that, we'll leave that up for just a minute. I'm going to give you a little insight into GHPIA. I know we have a lot of clients with us today, but we also have some guests. So we are a Denver-based registered investment advisor. We started in 1996. We are a fee-only advisor and a fiduciary. We currently have around $2.2 billion in assets under management. Our comprehensive financial process focuses on retirement planning, education planning, insurance review, income tax planning, estate planning, and mainly what we're going to talk about today, which is investment management or the stock market in general. Christian and I are going to run through some slides and some data points that we're talking about. Our expectation is about 25 to 30 minutes, and then we'll have time for questions at the end. There is at the bottom of your screen a question and answer button. If you click on that button and you type in a question, that'll feed through to us, and we'll try and touch on the questions that we get at the end of the presentation. So our agenda today, we're going to touch on some topics that we've heard from clients about or things that we've been monitoring in the market. Starting off with commercial real estate, I know there's been a lot of news about office buildings. Are they going to be vacant? Are leases going to come due and not get renewed? Things of that nature. We'll touch on some of those data points. Corporate earnings, we're right at the end of corporate earnings season for Q2 2023. So we'll talk about earnings and what we're seeing there. We'll talk about equity valuations and some trends we're seeing in the market right now and what we're monitoring. And then we'll finish up with soft landing, or what the Fed is calling a soft landing, and is it plausible that that can happen? And we'll kind of mix inflation into that too, and into that one as well. So we'll go ahead and get started. So here are some data points we're looking at when it comes to commercial real estate. And now, these are not all the data points we look at, but these are some of the data points we look at. So Castle Systems on the left here, the chart on the left, this is a work barometer by a company who does badge scans at office buildings. They have 2,600 scanners on office buildings across the United States in 138 metropolitan areas and cities. And what you're looking at here is how dramatic the pandemic really affected the United States. So on the left there, you can see that pre-pandemic, we were at 98% occupancy. Now this barometer, they do a weekly average of the top 10 cities or metropolitan areas in the United States. So pre-pandemic, 98% of workers were going into work. After the pandemic hit, you can see that it fell to around 15%. And if you think about it, essential workers and people who needed to go to work, who could not work from home, are in that number. So it makes sense it didn't go to zero. But as you can see, it has slowly increased from rock bottom to where we are today. And there are blips along the way. And a lot of those blips have to do with different variants that came out, different things that happened along the way. But I guess the main point and focus in this chart is that we're just below 50% where we were pre-pandemic. Now, this doesn't mean these are people that left the workforce. We get it. A lot of people went into a hybrid workforce, so they worked from home, and some go back into the office. But what this really shows is that less people are going into the office. So the question is, do we have an issue in commercial real estate since only 50% of the workforce has returned? And are offices going to be necessary? And is there going to be trouble when it comes to the leases and the financing behind these office spaces that nobody's going to anymore?
Yeah, and to kind of piggyback off Brett, another area of focus in the commercial real estate market is more of a retail shopping locations, specifically downtown retail and malls. So everybody probably knows malls have been under pressure for a number of years now. Basically, though, the pandemic and these new hybrid work schedules have really caused stress in some of the more downtown retail locations. So these shops, pretty much, they're relying on kind of office worker traffic, as to Brad just pointed out. I mean, we're not really seeing a return to the workplace. So this, along with the boom we have seen, is the chart on the right here, the boom in e-commerce sales, which, as you can see, during 2020 shot up almost 42%, have basically continued climbing at their pre-pandemic pace. And you can see in 2022, we actually surpassed 1 trillion in e-commerce sales. And despite this, this will probably surprise a lot of people, e-commerce sales still only make up 16% of total retail spending. So basically, there's still likely a runway for growth kind of in the online shopping space. Again, this is not to say that we're seeing kind of stress on all retail. We actually have seen, there's positive news coming out around suburban strip malls as people move out of cities and kind of adjust to their new work from home schedule. But we're really focused on here is more of your downtown retail, office, and malls. And to put some numbers behind the potential distress we are referring to, and actually even more specifically, basically we were asking, how exposed is the US banking system to the commercial real estate market? So it's estimated that the total mortgage debt outstanding on this non-residential commercial real estate part of the market is around 3.6 trillion. And you can see down here in the middle of the page that the total exposure to commercial real estate for US banks is around 1.8 trillion. So basically 50%. The other half is going to be held by, pension funds, other investment funds, REITs, insurers, and so on. But kind of the point out here, the 1.8 trillion, obviously it's a substantial amount of money, but you can also see that it actually represents just under 15% of the total loans held on bank balance sheets. And getting even more granular, we really wanted to look at kind of these commercial real estate loans that resemble more of the investor-owned office or downtown retail locations. And these are referred to as the CRE, the commercial real estate non-owner occupied loans. And the key here, and the differentiate between actual other commercial parts of the commercial real estate market, is the loan repayment on these loans typically is coming from rental income. So basically, if we do kind of see occupancy rates declined, it's likely that these more investor-backed loans would likely be the first to default in the coming years. And you can see here that the total non-owner occupied portfolio is just over 1.1 trillion, which is actually less than 10% of the total loans held by US banks.
Well, and I think to help put this into perspective, 10% of the loan book seems high, but back during the global financial crisis, or the mortgage crisis of 2008, 2009, if you look at the chart to the right, that is the 1 to 4 family first liens. That's basically mortgage debt. That was actually 50% of these loans back during the great financial crisis, or the global financial crisis, which shows that 9.42 or sub 10% of these types of loans is not near the scale that it was during that mortgage crisis, which is less concerning at this current time.
Yeah, and I think another interesting takeaway just from kind of this data table is really just looking at banks by asset size. So you can see the total asset size here on the left. But if you look over here, so the percent of these CRE non-owner occupied loans, you can see that there is some stress, and the most exposure does lie more in these smaller to mid-sized banks. For example, you can see the $1 to $5 billion asset size for a bank. About 20% of their loan book is exposed to these non-owner occupied loans. And this is very interesting as we go to the next slide, because here we're actually going to focus on the delinquent or bad loans in this part of the portfolio for banks. And I think it's just overall, once you pull the data, it's really interesting to point out that banks have really yet to see the repricing of many of these office or retail locations. And you can see here that the total non-performing, or again, just bad or delinquent loans in this part of the portfolio is only 11.1 billion on 1.5 trillion in the total loan portfolio. So basically it's less than 1%. I mean, put differently, 99% of loans in the investor-owned commercial real estate market are basically, they're currently being paid as agreed upon. So I think that's kind of interesting. And then the other interesting, which I just pointed out, is to kind of see where the bad loans are for these banks that kind of have higher exposure. I mentioned before the $1 to $5 billion asset size bank. You can see that their non-performing loans in this portfolio are actually only 0.35%. So we're really not seeing the stress kind of flow through the market as of yet. And another interesting thing we wanted to do, just to put this all in perspective, is we wanted to compare kind of what's currently going on in the commercial real estate market to what we saw during the global financial crisis. And this chart on the right is it's showing the total bad loans to the entire amount of banks, their total loan book. So you can see here that back in 2009, 2010, we actually reached 5%. So kind of going back to today's level, where we kind of saw that the total loan amount at banks is around 12.2 trillion. We would basically have to see this $11 billion number get to 500 billion to get back to this level for US banks.
And don't get us wrong, we're not oblivious to the fact that there are storm clouds brewing out on the horizon. There are very many plausible scenarios that could happen. But when you look at this line chart, the non-performing loans or the bad loans that happened, that line from 2006 to 2008, it looks like a straight up line. But if you think about it, that was over multiple years. And if you then look to the very right of the chart, we're at lows when it comes to bad loans on these books. So there is a runway that we look for when it comes to, if this starts to tick up, we have time to notice, we have time to react, and we have time to change things if we feel necessary at that time.
Yeah, and I think to Brad's point, we do see some stress coming. I mean, as this chart is kind of showing here, we're looking at the entire commercial real estate market here, and you can see that almost $2.2 trillion of loans are set to mature or be refinanced over the next 5 years. So basically, if we do see some of these occupancy rates decline, like some are projecting, there is likely to be some defaults. We're basically pointing out that, you know, most of the market, what we're seeing is not really significantly under stress, especially on the US banking side. And there's also good news, because the current headwinds that are facing the office and retail property sector, they're not, I wouldn't call them indicative of the same issues that really they arose from the leading, underwriting standards that we saw leading up to the global financial crisis. And I think a good point to point out here is that commercial real estate does differ from residential, and especially when we look at kind of loan to value ratios for commercial real estate. Most loan to value ratios at origination for a commercial property are probably around 60, 65, 55%. And when you're comparing that to a more residential type, where most people are putting, 20% down. So we're seeing kind of 80% loan to values. This basically just means that these CRE, the investors in these properties are starting with much more equity in the properties that they're holding. There's also news that we're seeing that, I think there was a report, I think it was just last week, that you're starting to see some firms actually raise capital to come in and scoop up some of these properties if we do start to see some significant discounts. The good news behind that is, as we do see billions of dollars being raised, is if we do see demand kind of tick up for some of these stressed properties, the price cuts might not be as severe as kind of we originally thought, back in the spring when this all started. And I think all in all, we really do not believe there's going to be systemic risk to the overall economy coming from kind of stress in this commercial real estate market.
Yeah, and I think we're also counting on the fact that if defaults do happen, it's not going to be a 1-for-1 and all of this debt will go upon default. But Christian, if you click back a couple slides for me, here. So to be honest with you, in our portfolios, we are investing across all of these banks. And I know as a percentage of total loans, the CRE debt seems high. But when we look at it, in a diversified portfolio, we're not overweighting these banks by any means, but the banks we are buying, we are doing deep analysis on the balance sheets and we're looking at their loans. And we can say that when we look at the average size of these types of loans in the banks that we're purchasing, it's just above 3% of their total loan portfolio. I mean, if you look down the line on the very right, this just above 3% is the upper echelon of 1 trillion or above size banks. So even though we do have some exposure within our banks, we're not as concerned right now because of the size of the loan book that these banks do hold.
So kind of moving on here, we're going to talk about the latest quarter kind of earnings update. I would say overall for the S&P 500, there's very mixed results. However, earnings growth for the S&P, it did remain in negative territory in the second quarter. So this does mean we still are in an earnings recession. However, I would say we did see some positive trends coming out of the June quarter. So the chart on the left here is kind of highlighting what the actual earnings growth was compared to kind of what estimates were coming into the quarter. And you can see here that 9 of the 11 S&P 500 sectors actually did come in better than feared. And you could see the S&P 500 as a whole, second quarter earnings fell 5%, but coming into the quarter as of June 30th, analysts were expecting a negative 7% year-over-year print for earnings. So overall, I would say that's actually positive. That's one of the positive trends we did see. We're also seeing some strength in some areas of the market, consumer discretionary over here. So obviously we saw 52% year-over-year earnings growth in this sector. And this is really boosted by strong travel demand, which is really benefiting a lot of these hotel and leisure stocks. We also saw some outperformance in some of the auto and auto component companies as well. The communication services I wanted to highlight as well. So you can see there almost 20% year-over-year earnings growth. And this was pretty interesting because the story behind this is really kind of a re-acceleration in ad spending, despite a lot of this broad economic concerns we're seeing across the market. Industrials was another winner for the quarter. You can see 12% year-over-year gain. Analysts were predicting just a 5% gain as of June 30th. So here we're also seeing a lot of the aerospace and defense companies outperforming. That's really thanks to just surging global defense budgets. Obviously, we all know we've seen a lot of geopolitical tensions here late, but we're also seeing, the building products, machinery companies, because basically construction and infrastructure spending it's remaining strong as of now. Material, kind of the two laggards for the quarter were materials and energy. And the big story here was really just lower commodity prices for a lot of these companies, which really just hurt the bottom line. Kind of moving to profit margins. So the second quarter profit margin did fall to 11.5% compared to last year's print of 12.2%. However, the positive spin is that when we do compare to the first quarter of 2023, margins were actually flat. And we read this as a positive trend and a sign that a lot of this inflationary pressure maybe could be coming to an end. And just to kind of give some background on that, what's happened over the past year is a lot of companies were hit with, higher raw material costs, transportation costs, increasing wages for employees, which were really dragging down margins. And we also saw, and we're kind of still seeing, but it's toward the end of it, is we're seeing a lot of companies work through their high cost inventory, which is really putting a drag on the bottom line as well. So basically seeing this flat quarter over quarter print for margin should really bode well for margins moving forward, and we might really see the bottom. And I think this trend, if we look on the chart on the right here, I I think this trend is starting to show for analyst estimates moving forward as well. You can see that, so the third quarter, analysts are actually projecting earnings growth of 0.2%, which by definition would actually move us out of this earnings recession. But the big jump that we might see here is the fourth quarter, the market expects earnings to grow nearly 8% year over year. And I think the good news here is if we do see this high single digit earnings growth by year end, it would actually push full year 2023 earnings above 2022 levels.
And I think if you look at the chart on the right, the earnings per share, you can see almost cycles in the process. You can see when we've had earnings recessions or actual recessions back, and there's a difference. Earnings recessions, are if earnings fall, but we don't fall into a recession per se. So the tech bubble in the 2000s, you can see earnings fell, obvious reasons. In the global financial crisis, same thing happened. Well, if you step back and look at this from a 40,000-foot view on what's going on now, you look at 2020 when the pandemic hit. Obviously, a lot of things happened. People went into lockdown. People stayed at home. People did not spend for a time, and corporate earnings fell. Makes sense. Then what happens? Demand picks up rapidly. That's where you see where the laser pointer is right now, right around 2021. People had been cooped up in their houses. So what did they do? They started spending. They wanted to fancy up the house, buy some fertilizer, buy a new TV. They got tired of looking at the same bathroom, so they wanted to redo it, all that. Well, companies, what did they do? They realized that all this demand was being pulled forward that didn't happen in 2020, and it spiked. Well, companies went ahead and expanded. They expanded operations. They hired more workers when people started back into the workforce, and their costs went up higher. Well, then you could see what happens this year is people's sentiment changed, and they decided, I don't need another big screen TV because I'm not at home as much anymore, because now I want to go out and have adventures, and I want to travel, and I want to do different things. And so all these companies that overproduced and built up inventories and overexpanded have realized, holy cow, our earnings are dipping because of this. So we need to start cutting costs, which has started to happen in what we're seeing in a lot of the earnings that are coming through. So therefore, it makes sense that once they level that playing field after these two shocks to the system, earnings should start to steadily increase, which would be very beneficial for the market. And so moving from earnings to equity valuations, these two charts are fairly interesting and something that we're monitoring. So the chart on the left is tracking the S&P 500, and this is return data indexed at 100 from the beginning of the year. And you can see the middle line, the gray line, that is what the S&P 500 has done year to date. We did dip and get to a flat point in February, but currently, I'm not exactly sure where it closed today, but we're up about 15% year to date on the S&P 500, but not as all as it seems. If you look at the underlying constituents within the S&P 500, the top 10 companies in the S&P 500 is the green line above. Those 10 companies alone, which make up 33% of the S&P 500. Now, full disclosure, the S&P 500 has 503 stocks in it right now. So the top 10 stocks are accounting for 90% of the returns year to date for the S&P 500. Now, let me say that again, 90%. There was a point throughout this year where they made up 100% of the return of the S&P 500. So what does that mean? If you look down at the blue line at the very bottom, there are give or take 493 stocks that did not make up 90% of the return for the S&P 500. So it shows you that just paying attention to the S&P 500 does not give you a full market dynamic. Now, those top 10 stocks that have outperformed dramatically this year, a lot of it has to do with the hype on generative AI and things of that. So they are tech-based stocks, but they are accounting for most of the return year to date. So then if you push that to the right chart, we're looking at valuation here. And when we're looking at valuation, we're looking at price to earnings ratio. And price to earnings ratio is exactly what you think it is. It's your price over your earnings per share. So when you get an elevated price to earnings ratio, typically there's a few scenarios, but the one that happened here is that prices increased dramatically and earnings increased as well, but they did not increase at the same pace as prices. And you can see a lot of that. So the green line are those top 10 names again. Those top 10 names, the valuations have spiked dramatically. And full disclosure, we do buy some of the names within those top 10 names, but we still look for the ones that are reasonably valued compared to a market multiple. Now, they have driven the valuation of the overall S&P currently at about 19 to 20 times earnings, which is higher than a typical market multiple, which is around 17 is where you would think the S&P 500 should sit. So therefore, it looks as though the S&P 500 is overvalued compared to where we've been historically. But if you look at the line below, the gray line, that is the S&P 500 as a whole. So all those other stocks, the other 493 give or take stocks in that index are reasonably valued, or many of them are reasonably valued, keeping that valuation at a decent level.
Yeah, and I think Brad is obviously exactly right. I mean, the big names are driving most of the returns this year. However, I mean, our belief in general is that this is pretty much unsustainable, especially some of the growth rates that we're seeing put on the stocks. I think an interesting thing is the market, I believe, is starting to realize this as well. Because if you look at just 2 months, the mid and small cap indexes have actually outperformed the S&P 500. And as I mentioned before, I think a lot of the shift is really just due to the market realizing that all of these mega cap tech stocks have really gotten ahead of themselves from a valuation standpoint and kind of started to rotate into more of some of these smaller cap names. Whereas the chart shows here, you're basically getting almost a 30% discount from a PE multiple standpoint. And kind of interestingly enough, you're looking at the mid cap and the small cap 600. If you compare to their 20-year averages, they're trading well below, while the S&P 500 is now trading 10% above. And kind of as Brad mentioned, we do buy a lot of these mega cap tech stocks that dominate the S&P 500. However, 45% of our client portfolios are allocated to mid and small cap companies. And the reason behind that is we really do believe allocating to different size companies, as well as different sectors and styles, is really the key to long-term wealth accumulation in the stock market. And I think it's even more apparent when we're seeing this significant valuation discount in some areas of the market, like we're pointing out here, between the small and mid-sized companies. So for the last few slides and to wrap up, we really wanted to focus on more of the macro environment and the trends we are seeing in the data. So over the last few months, I would say a lot of the recent trends have definitely favored those in the soft landing camp. You can kind of see what we labeled this section, soft landing still in the cards. The latest July CPI print was just 3.2%, which is obviously, it's down significantly from the 9.1% we saw last summer. But I think it's important to say we are still seeing some parts that are sticky, primarily shelter. However, most areas have come down dramatically. I think the shelter component is extremely interesting, given it's more than 30% weighted to headline CPI, but it does operate with a 9 to 12 month lag based on estimates. And this is really just due to the nature of the survey that the Labor Department conducts to calculate shelter inflation. However, we also look at other market indicators that are more live, like new rents and just in general house prices. And we do see that overall shelter costs have really slowed dramatically. And we believe this should help push inflation further down over the coming months, even if we do continue to see some volatility in the numbers. Another interesting chart here is on the right, and this is average hourly earnings on a year-over-year basis. So this one, I believe, will be a very closely watched metric for the Fed over the coming months. As you can see, we are well off the peak of almost 6% back in early 22. But over the last few months, we have kind of seen that yearly wage growth kind of settle in that 4.5% range. But there are good news because, we are seeing signs in some of the labor reports that kind of point to a further deceleration in wages. A couple of those would be the total number of job openings continues to trend down. I think during peak and during the pandemic, I think we got over 12 million job openings. We are currently at around 9.5 million. We're also seeing the quits rate come down, which is a good measure of job market confidence. If somebody wants to quit a job to go to another, they would expect a higher pay raise. That continues to trend lower, and it's actually approaching pre-pandemic levels. And kind of just on the wage side, basically what's happening is employees really do not have the leverage that they once did kind of over the last couple of years. I mean, there's a point where we were seeing job switchers during the pandemic. We're getting 9-10% pay raises. That's now down to just over 6%. And we're also seeing just overall job gains decelerate, which is kind of pointing to that it's been a very resilient labor market, but not too hot, not too cold at the moment.
Well, and I think to Christian's point, even from his last slide, we saw inflation spike. We saw it come down as fast or nearly as fast as it went up. That's great. But during that time period, we saw wages spike. Now, don't get us wrong. Wage increases are important because more money in people's pocket, the more money they can spend on the economy and help the economy grow. But there is a threat of wages increasing too fast. And we saw that for a period of time. You might have heard the term wage price spiral in the news said many a times. And basically what that is that if producers need employees and they start hiring and they have to hire those people at an increased wage, they then typically have to increase prices and then pass that on to us, the consumer. Therefore, your wage price spiral, they keep hiring people at higher rates, prices keep going up, and that could be a self-fulfilling prophecy. So the fact that wages have started to come down and even flatten is a good thing. They are still increasing, but they're starting to flatten. So with that, you look at what happened here on the left, the non-farm payrolls. These are jobs added. And we came off a very rough time during the pandemic. We had near 22 million jobs lost, a lot of them, in the service sector. So with that, it's not surprising that you see these spikes in jobs added from 2021 to today. But the trend, as you can see, is coming down. And the fact that it is flatlined over the last few months, because this is a monthly reading, is beneficial, even though it seems like, well, we want to add more jobs, we want to continue to have the economy grow, but too fast can be bad for inflation, and that is something that the Fed does monitor. So if you think about it, we've added 187,000 jobs each month over the last 2 months. The average from 1950, I think, is about 155,000 jobs a month. And the average from 1970 is about 165 to 170,000 jobs a month. Well, during times of recession and contraction, you typically will see job loss. So the fact that even though the jobs added are slowing, the fact that we're still adding jobs is very beneficial to the economy. So we hope to see this trend continue, because we do not want to get to a point where we're seeing job losses and these numbers as at a negative. But what's also beneficial to us is if you look at the chart on the right, the prime age labor force participation rate. Prime age is workers between 25 to 54. And ever since the late 1990s, early 2000s, job participation has decreased, and it has been decreasing rapidly. And we got down substantially during that time period. And you can see that here on the chart, right around 2014-15, it started to increase again, which is great. More people are stepping back into the workforce, especially after the pandemic. We need that. We need more people in the workforce to help generate and drive the economy. What's nice to see about this participation is that we're getting back to pre-pandemic levels. You can see on the right side of the chart, that big drop off is the pandemic. We're not quite back on trend when it comes to where we were pre-pandemic, but it's good to see that we're headed in the right direction. So I guess to bring it all full circle, it's good to see that earnings potentially are going to pick up, that valuations are not as elevated if you start stripping out certain aspects of it. But when you take all of these economic points into account Inflation is coming down. Wages are steady. We're still adding jobs. Participation's picking up. It seems to be a heavy tailwind for the U.S. economy going forward. Now, the Fed had said, and you probably heard, recession, recession, recession for the longest time. And you say it enough, and you say we're 1 month away from a recession, we're a quarter away from a recession. You can hear that so many times. Well, that hasn't come to fruition yet. And we hear it every quarter, every month. We're 1 quarter away from recession, 1 month away from recession. Well, if you say it long enough, eventually it will probably come true and you can say you were right. But the main scenarios for the Fed was recession, soft landing, which is bring the economy back down slowly and not push us into a recession, or no landing at all. What we're seeing with these tailwinds and a lot of this economic data is that we have the potential for almost what we would call a touch and go landing. We're hoping the Fed can continue to bring inflation down to their mandate of 2% or near 2% without driving the economy into a recession. But the way this is lining up is that there's potential that we could drive it down for that soft landing and touch and go again from an economic standpoint if earnings pick up and a lot of these data points continue to show signs of growth. So that is wrapping up our market update, I would say. Christian just threw up a slide. It has our information. If you have a question you want answered that you don't give us today or we don't get to today, feel free to reach out to us independently, email us, call us, whatever. We're happy to have the conversation. We enjoy having the conversation. Let's go ahead and jump over to questions. Let's see. We had a question come in earlier on what are we doing with cash? I think it's probably on a lot of clients' minds, and I think people want to know, are we just sitting in cash? And Christian, I don't know if you have.
Luckily, I have a slide for that.
Okay, well, look at that. So with that, what are we doing with cash? Well, if you haven't noticed recently, your bank, even though interest rates have spiked, and if you're at, one of the big banks right now, you're getting 0.1% of interest, 0.1% interest on your cash. And so we've had a lot of questions like, what are we doing with cash? How are we handling it? So what we're looking at right now is bank cash makes no sense to us. If it's 10 basis points, it's not worth keeping it there. So, and high yield savings is slightly higher at just over 4% when it comes to yield on your cash, which is great. For the longest time, we got 0 or 0.01% on cash. And I know that was frustrating because you don't want to put all your money into the stock market, or you have cash needs and cash flow needs. So you need to keep some on the sideline. Well, it's nice to see yields coming back. Well, where we stand right now is we have been moving money into money market funds. And currently the money market fund that we've been closely tied to it's at about 5%. Which is substantial compared to where we've been for the last few years. And so most clients would see that there is a cash position on their account, probably very, very minimal, but most of their cash is sitting in that money market fund earning that 5%. And we are doing that frequently and often. So what else we got, Christian? If you have anything to add too, I don't know if. Did you want to touch on anything?
Hold on. It looks like we did get a question come through here.
Here we go. We knew that one was coming. What would you agree that the general consensus that the Fed won't raise interest rates by more than 25 to 50 basis points over the next year? Do you see that helping ease the uncertainty in underwriting? Do you want to take it or you want me to?
Yeah, I mean, I can at least the first part. I mean, I believe the current consensus is for the November meeting. So we have a September meeting coming up. And I believe the Fed will likely hold rates at 0. And I believe if we look at percentages, I think it's 70% that the Fed will not hike at the November meeting. And that kind of goes back to a lot of the data from the macro slides when we were looking at kind of the trends we are seeing. And I think, again, one of the more important areas is going to be wage growth and wage inflation. I'm sure some have heard about the core X housing number that the Fed is kind of focused on. That is a lot. If you look at the percentage breakout, it is going to be tied to wages. So if we do start to see kind of as the data is showing that the labor market is starting to cool, I do think that the Fed is likely done. But I mean, I believe at least our kind of thought is we've already seen, rates go from 0 to 5.5%. So another 25 basis points is it's really not that significant. But overall, I think our consensus is that the Fed is, again, everybody's probably heard this. I do think they are going to be data dependent, but it does seem like we are very, very close to the end.
I agree. And I think, oh, go ahead.
But I forget what the second part of the question was here.
Do you see it helping to ease uncertainty in underwriting? I mean, rates are high right now. I'm trying to get a mortgage loan right now is out of control. So it is putting a damper on affordability, I think. But let me touch back on Christian's point. The fear is over tightening. And if the Fed raises rates, I mean, they raised at a historic level over the last year. And you saw it, if you raise rates fast enough, something will break. And we started to see things break. And right now, the housing market, last I checked, I think a 30-year mortgage was over 7%. Is that about right?
Yep.
So there's two ways to look at it. Volcker, who was the Fed president back in, most people on here potentially remember the 70s, how quickly rates went up and how high rates went because they needed to squash inflation. Well, Greenspan in the 90s took a different approach than Volcker and didn't spike rates as dramatically, but he took what they called an opportunistic approach to the rates. And he raised as fast as he needed to without pushing the economy too far down. And it seems like the Fed is kind of taking that route right now. It's kind of a wait and see, look at the data to figure out if more rate hikes are needed. But I do not think that more than a 25-point basis hike at a time is necessary, or many more are necessary, because we've already seen inflation. I think the key number is below 3%. And if we see inflation start to get below 3% and closer to that 2% mandate, we're on the right track. And we're either in the market for that soft landing, but if they come down quick and they get below 3% at a faster pace, then we're at that touch and go that we talked about at the end of the presentation. You got anything to add?
No.
Let's see. Do we have any more? Good question. I don't see any more questions. So I promised you we'd keep it about 25, 30 minutes, which we did. We were leaving about 15 minutes for questions, and I think we're right around that time frame. So I want to say thank you to everybody for attending today. We hope to do many more of these in the future. Again, Christian, if you put our contact information back up, here is our contact information. Take it if you want it. Reach out to us anytime. If a question comes up after the call, let us know. We're happy to have the conversation. And if you have anybody else that you think wants to have that conversation, let us know. We're happy to call them ourselves. So thank you all very much for attending. And we hope to, not see you in the future. We are, you can only see us at this point. So have a great evening.